Welcome to the NPERS Social Security presentation. This presentation is designed to give our members a broad look at the Social Security program, as it is a basic part of many people's retirement plans. During the presentation, we're going to go over what makes you eligible for a Social Security benefit, how to calculate that benefit, and various other aspects of the program. NPERS does not calculate or administer Social Security benefits, so if you have questions about this program or about a claiming strategy, please contact the Social Security Administration or a licensed financial planner. Social Security was established as a program in 1935 as part of FDR's package of New Deal legislation. It was designed to help retiring individuals who were affected by the more than 10,000 banks that failed or the 25% unemployment rate that was going on during the Great Depression. Social Security is a pay-as-you-go system. What that means is that as people pay into Social Security through payroll FICA taxes, this money is being paid out as benefits to people who are currently receiving Social Security. It is designed to replace a portion of your income, that portion being approximately 35 to 40% of your average monthly earnings. The Social Security benefit is a benefit that is paid for your lifetime, so should you claim at full retirement age, that payment would continue for the rest of your life. Social Security has undergone a lot of changes throughout the years. The program expanded in 1939 to include survivors insurance for families of deceased workers, and again in 1956 with disability insurance for disabled workers and their family members. In 1965, Medicare began providing health insurance for Social Security beneficiaries. Most beneficiaries are retired persons. About one-third are disabled, dependents of those with disabilities, or survivors. Additional benefits for spouses, widowed spouses, and children under 18 are available through the Social Security program. We're not going to cover these scenarios in our presentation today, so if you review this slide and believe that one of these scenarios pertains to you, please contact the Social Security Administration or review their website at ssa.gov. The contributions to fund the benefits that are paid out by Social Security come from our payroll taxes or FICA taxes. That's 6.2% of our first $168,600 in earned income. There's also an additional 1.45% tax that is allocated for Medicare on our entire income. Both of these are matched 100% by your employer. If you make over $200,000 individually, or $250,000 as a married couple, you're also subject to an additional 0.9% Medicare tax. To be eligible to receive Social Security, you need 40 credits. You can earn a maximum of 4 credits per year, and this is based on how much you earn. Each year, the dollar amount for a credit can change. This year, if you earn $1,730, you have 1 credit. So, if you earn $6,920 this year or more, you've earned 4 credits. Because you can only earn a maximum of 4 credits per year, it takes most individuals 10 years to become eligible for their Social Security benefit. Now that we know what makes us eligible to receive a benefit, let's talk about how those benefits are determined. As we said before, Social Security is used to replace 35 to 40% of our lifetime average monthly earnings, so we'll need to know what our lifetime earnings were. We'll then need to place those into a formula that determines what percentage that we will get. Finally, our benefit amount will be greatly affected by when we decide to start drawing benefits. In determining your lifetime earnings, the Social Security Administration takes a look at your 35 highest years of earnings. They then apply an indexing factor to each year that brings all 35 years to current dollar values because the dollar that you earned in 1987 is worth around $2.68 in 2024. These 35 highest years of earnings do not have to be consecutive, and the average, of course, is going to be decreased if we have lower years of earnings or years when we had no earnings at all. Now, once all of your 35 years have been indexed to today's value, they determine an average of those 35 highest years of earnings. This is done by adding them up, then dividing by the amount of time, which in this case is going to be 420 months or 35 years. Our example here is $1,829,606, so we'll divide that by our 420 months. This gives us $4,356. That is our average monthly lifetime earnings. Now we need to drop that number into our income replacement formula. Once again, Social Security is designed to replace only a portion of our income, so that's what this formula does. The lowest replacement formula bracket will replace 90% of that amount, the second bracket 32% of that amount, and that last bracket will replace 15% of that amount. Let's review a practical example by placing our amount into the income replacement brackets. In our previous example, we got the average lifetime monthly income of $4,356. We'll apply this amount to the bracket. The first bracket that we put this in, if you've earned $1,174, 90% of that will be ours to keep. We set that aside. That would be $1,056.60. Looking at the second bracket, we have to subtract that $1,174 that we used in the first bracket from our initial $4,356, which gives us $3,182. Now, 32% of that amount is also ours, so we put $1,018.24 to the side. If we had an average monthly earning that was over $7,078, we would get to keep 15% of that amount, but in this example, we do not. When we add the brackets that we get to keep, $1,056.60, and add that to our $1,018.24, that gives us $2,074.84. That's what our Social Security benefit would be if we claimed it at full retirement age. The next thing that determines our benefit amount is when we decide to take our Social Security benefit. Everyone has a full retirement age as determined by the Social Security Administration. And if you review the chart on this slide, it'll show you what your full retirement age is currently. If you claim your benefit prior to your full retirement age, there is a permanent reduction in your monthly benefit. If you wait until after your full retirement age to claim benefits, there's an increase in that monthly benefit amount up to age 70. The reduction and the increase are not figured using the same form. The reduction for claiming your Social Security benefits prior to your full retirement age can be as much as 30% if you claim at age 62. The reduction for claiming is a permanent reduction. However, there are still many good reasons to claim your benefit early. You have to consider your health, your work, and your family history, and that's critical to determining when you should take your benefit. Someone who has claimed early may receive smaller payments, but perhaps they'll receive more of them. The increase if you claim your Social Security benefits after full retirement age is approximately 8% if you wait until after age 67. However, after age 70, the benefit amount will not increase, so make sure if you're waiting to take your benefits, you don't wait past age 70. It should be said if you're adding new highest salaries or highest years of earnings to your 35 highest years by continuing to work past that age, you're still increasing your benefit. This graph is a good representation of how the reduction and increase in benefit amounts can be affected by when you claim them. See how a normal benefit at full retirement age is $1,000 in this example? If I claim at age 62 with that 30% reduction, then my benefit amount would be $700 a month. Conversely, if I could wait until age 70 to claim my benefit, my monthly benefit is going to be $1,240. When to take your benefit is a personal choice that should be based on your individual financial situation. Another increase in our benefit is the COLA, or cost of living adjustment. The COLA is 3.2% this year, and that's based on the Consumer Price Index, or CPI. Eligibility for a COLA starts the year a person turns 62, even if that person does not claim benefits at that point in time. Let's talk briefly about the earnings test reduction. The earnings test reduction is going to apply only to certain individuals who have applied for and started taking their benefit early, and they've continued working and are still earning. Understand that this does not encompass any retirement income that you may be getting from a pension plan like an NPERS annuity. It's also not a permanent reduction like the reduction for taking your benefit early, say at age 62. At the point in time when you reach full retirement age, the earnings reduction will no longer apply to your benefit. Your benefit will also be recalculated, and what has been withheld will be put back into your benefit amount continuing forward. Before full retirement age, you're responsible for reporting the need for this reduction to the Social Security Administration. Let's look a little bit more at the earnings test reduction. In 2024, the earned income limit is $22,320. So if you took your benefit early and you're working a job at which you earn over $22,320, then for every $2 over that limit, Social Security is going to keep $1 from your benefit. Let's look at an example of this that'll help us understand the earnings test reduction a little bit better. If our Social Security benefit is $1,000 and we took that prior to full retirement age, and we then earned an estimated $25,000 in earned income this year, we'll need to subtract the earned income limit of $22,320 from that amount, which gives us $2,680. Now, remember, they're only going to withhold $1 for every $2 that we're over that limit, so we have to divide that amount by 2. That gives us a reduction of $1,340. It's important to note that the Social Security Administration will withhold a whole benefit payment to satisfy the reduction, so if our benefit is $1,000 a month, then they will withhold 2 benefit payments. At the end of that year, the remaining $340 will be returned to us. The earnings test reduction, as we mentioned before, no longer applies once you reach full retirement age. The earnings test reduction is also not permanent. The reduction for taking your benefit early is permanent. Let's talk about federal taxes on Social Security. For the year 2024, our combined income will fall within certain brackets to tell you how much of your Social Security benefit will be considered taxable. To figure out our combined income, we need to know our adjusted gross income. We also need to know 1/2 of our annual Social Security benefit, and then we need to know if we're going to have any non-taxable interest. Now, non-taxable interest is generated by things like municipal bonds. It's also of note that the earnings reduction test does not include annuity payments from your NPERS plan. That is for earned income. AGI will include those payments. For the AGI, we're going to use our combined income. Payments from your NPERS annuity will be included in figuring your AGI. Looking at our example, if our adjusted gross income is $30,000, we have no non-taxable interest, and our Social Security benefit for this year will be $18,000, half of which would be $9,000. We add those up all together. $30,000 plus 0 plus $9,000 equals $39,000. $39,000 will be our combined income. Now we take that $39,000 of individual combined income back to the brackets for taxation that we showed on the slide before. Because we earn over $34,000, 85% of our Social Security benefit is subject to income tax. So we take our adjusted gross income, we add that to $15,300, which of course is 85% of our $18,000 Social Security income, for a total taxable income of $45,300. That $45,300 would determine which income tax bracket we will be paying taxes from. As of the 2023 legislative session, the state of Nebraska no longer taxes Social Security benefits. When talking about Social Security, the subject everyone wants to discuss is solvency. People want to know if the program will be solvent enough to be around when they're ready to take benefits. One factor affecting the solvency of Social Security is life expectancy. When the Social Security program started in 1935, the life expectancy was 12.5 years past age 65. Right now, it's over 20 years past age 65. Another factor is that Social Security was also expanded to include more benefits. And finally, right now, more and more members of the baby boomer generation are taking their benefits from Social Security. However, a 2020 Pew Research study indicates that millennials in the workforce have outnumbered the baby boomer generation 72 million people to 71,600,000 people. What that means is we will still have payroll or FICA taxes coming in to be then distributed as benefits. If Congress does nothing, according to the Social Security Administration, after the depletion of the Reserve Trust Fund in 2034, continuing income would be sufficient to pay 80% of program costs, declining to 74% in the year 2096. Congress has already done some things to help with the solvency of the Social Security program. They've increased the full retirement age to 67, and we're also taxing Social Security benefits at this point in time. But some things Congress might do, they might increase the FICA taxes. They could increase the tax percentage, that's the 6.2% that we discussed earlier, or they could increase the income cap, that's the $142,800 we discussed. They could also increase the full retirement age, once again, or they might decrease benefits. All of these things would make the Social Security program more solvent. Another thing that could be changed or adjusted to help the solvency of the program would be the cost of living adjustments. That's the COLA that we discussed. When we talked about cost of living adjustments earlier in the program, we discussed how they're attached to the CPIW, that is the Consumer Price Index for urban wage earners and clerical workers. Basically, with the CPIW, we're looking at a large basket of goods and services and their prices. There's going to be a lot of things in this basket. Services such as a haircut, a gallon of milk, or the price of a tank of gas. These things are then measured against this very same basket containing the very same services and goods from the previous year to give us an idea of what inflation might look like. We could use the chained CPI or the CPIU to figure COLAs for Social Security benefits instead. The chained CPI looks at that same baskets of goods and services. However, it takes into account that when a product or service becomes too expensive, people may substitute a cheaper version of that good or service. An example of this would be if you go to the store and you always buy a brand name box of cereal, but unfortunately when you go to the store this time, that brand name cereal has gone up $2 a box. In that case, you may look down the aisle and decide to buy the generic version of that cereal instead. That would be a substitution. With these substitutions taken into account, the CPIU would decrease the amount of COLAs in general. We could also instead use the CPIE. The CPIE has an important difference in that it takes into consideration households who have an individual in them who is 62 years of age or older. What do you think that a 62-year-old would spend the most money on that's a good or service? That would be healthcare, and once healthcare costs are taken into consideration, it's a good guess that the CPIE, when used to calculate COLAs, would probably increase them. Visiting SSA.gov will allow you to create your own mySocialSecurity account. When you create a mySocialSecurity account, you'll be able to receive personal estimates of future benefits, review your earnings history, and apply for benefits online. You can also review your annual statement. To create a mySocialSecurity account, you need to have a valid email address, your Social Security number, a U.S. mailing address, and be at least 18 years of age. They would ask that you only create an account for yourself and not anyone else, even if you have their permission. When you visit socialsecurity.gov/myaccount, you're going to select Sign In or Create an Account, and they're going to ask you some personal information to verify your identity, and you're going to enter that information in order to create that mySocialSecurity account. You'll then select a username and password, and they will send you a one-time passcode in order to verify your email. Once you create your account, at the top of your page will be your personalized estimate of benefit. As you can see here, this estimator will give you an estimate of what your benefits would be at early retirement age of 62, at full retirement age, and if you held off on getting your benefit until age 70. You can create customized estimates for your benefits as well. For example, let's say you are 65 years old and you're ready to retire. You're going to take your NPERS benefit, but you want to wait until you reach full retirement age to take your Social Security. You can put in the estimator that you plan on earning $0 from the time you're 65 until you reach full retirement age. It will then adjust your estimate based on that information. Next, it'll ask you to enter your last year's earnings. This should be an annual amount. Now, why would it ask you for something like this? Well, because it's an estimator, so the guess that it's making using last year's earnings is that you're going to be making that amount up until you would like to claim Social Security benefits. You can also apply online for benefits if you have a mySocialSecurity account, as long as you're at least 61 years and 8 months old, as long as you're not currently getting benefits, you haven't already applied, and you want your benefits to begin no more than 4 months in the future. There is also a 1-minute video on SSA.gov to instruct you on how to apply online. To apply online, review the information needed to apply and start a new application. For this application, you can sign in and complete it all at once, or if you need to go back and find some information, you can save and go back to your saved application to finish. If your preference is to apply in person, you can still do that as well. These are the phone numbers to all of the Social Security offices here in the state of Nebraska. You may call the one closest to you to set up an appointment. Thank you for watching our video today. For more information on Social Security, the program, I'd like to invite you to visit ssa.gov. Thank you.